This week we've been discussing Chapter 12, which is dealing with the accounting procedures for partnerships. So the first example that we'll look at will be the journalizing entries that would need to be made in order to form a partnership. So Moss and Barber organized a partnership on January the 1st. Moss's initial net investment is $75,000. And that $75,000 consists of $17,500 in cash and $82,500 in equipment, and a notes payable reflecting a bank loan to the new business of $25,000. Barber's initial investment is in the amount of cash in the amount of $31,250. And so the first thing we will do is we will prepare the journal entry for Moss's investment. And so we will debit cash in the amount of $17,500 because that is the amount of cash that the business is receiving from Moss. And then we will debit equipment in the amount of $82,500 because that is the value of the equipment that the business received. And then we will credit the notes payable in the amount of $25,000. And then we would credit Moss Capital $75,000. And then to record Barber's investment, we would debit cash in the amount of $31,250 and then credit Barber Capital $31,250. And then we see then that Moss has a capital balance, which would be a credit of $75,000 and then Barber would have a capital balance of $31,250 credit. And so it's a credit because that is the amount of capital that each of these two individuals have in the business. And that, remember that capital would fall under the equity portion of our equation. So remember that assets equal liability plus equity. So keep that in mind as you work through these. So Steffi and Lee form a partnership. Steffi invests $1,000 cash, $2,000 of supplies, inventory with a book value of $3,500 and a market value of $3,000, and machinery with a book value of $4,900, market value of $4,000. And so we'll go ahead and prepare the partner's journal entry for Steffi's investment. And so we would record a debit to cash in the amount of $1,000 because that's the amount of cash that Steffi is investing. Now supplies, we would also debit supplies in the amount of $2,000 because that's the amount of supplies that the business is receiving. Now inventory, you would record with the market value. So market value of the inventory was $3,000. So we would debit inventory for $3,000. Same thing with machinery. You would be interested in the market value. And so you would debit machinery in the amount of $4,000. And then finally, we would credit Steffi Capital for the total investment of $10,000 for Steffi Capital. So credit Steffi Capital $10,000. The income allocation in a partnership. Raymer and Knox began a partnership by investing $60,000 and $90,000 respectively. Now, during the first year, the partnership earned $160,000. And so what we will do is we will prepare the calculations showing how the $160,000 income is allocated under each separate plan for sharing income and loss. So the first thing you could do is, if they fail to agree upon a method to share income, then the income would be split 50-50 with each partner, irrespective of the amount that they invest in the partnership. And so in this case, half of 160 is 80. So both Raymer and Knox each would get $80,000 income. Now, another way that you can do it is you can figure out and share the income and loss in proportion to their initial investment. And so we see here that Raymer, remember, invested $60,000, Knox invested $90,000 for a total investment that both of them invested a total of $150,000. So we figure out how much fraction percentage each of them invested. So we see, so we would take 60,000 divided by the total investment of 150,000. That gives you the fraction of how much, and then Knox, we get 90,000 divided by 150. So we see here that if we do this, in fact, so we take 60,000 divided by 150, that comes out to 40%. So if we take 60,000, or no, 160,000 multiplied by 0.4, you come out with 64,000. Okay. Then to figure out then how much Knox had, you could figure this out two ways. You could just take 160,000, which was the profit, minus the 64 from it. You get 96,000, and that's how much Knox would get. Another way you could do that is to take 90,000 divided by 150,000 is 60%. And so you could take the 160, multiply that by 0.6, would get you the same answer of 96,000. So that's how you would do it based upon how much they invested. Now, another way that you could do this, and this gets a little bit more complicated, is if the partners agreed to share income by giving each of them a 50, or pardon, they get a salary, but it's going to be a little bit different. So the partners could agree to give $50,000 a year salary allowance to Raymer and a $40,000 per year salary arrangement to Knox, and then a 10% interest on their investments, and then the remaining balance would be shared equally. So there's a lot of pieces here. So the first of all, we see that the net income is $160,000. So we have the allowance for the salary, 50,000 and 40. So that would have to come out of this 160. And then if you figure out then the amount of interest, so be 10% of 60,000 for Raymer and 10% of 90,000 for Knox. So it'd be 6,000 for Raymer, 9,000 for Knox. So that brings us to then that Raymer for total salary and interest is 56,000, and then Knox is 49,000. So that means right now that we've already allocated 105,000 to it. Then we said then that the balance of the income then would then be shared equally amongst the partners. And so if we take that, the balance of the income then is 55,000, and so they each would get 27,005. And so then the shares for the partner then, Raymer would get 83,005 and Knox would get 76,005. And that then has then allocated all of the income. We'll do another one. So that last portion that we talked about, they had a net income, or another way of saying net income, remember, would be a net profit. So the company's doing good, they're making money, that's great. Remember that partners also have to share either both in the profit, which would be a net income, but remember also that they would also have to share in the net loss. And remember that partners, they are responsible also for the losses of the business personally, okay, unless they're considered a limited partner. But in this case, that we're not talking about that. So let's look at another example. So again, Raymer and Knox, they did this, and the numbers are a little bit different. So same thing, they invested $60,000, $90,000 respectively. The partners agreed to share income and loss by giving an annual salary allowance of $50,000 to Raymer and $40,000 to Knox, 10% interest on their investment, and any remaining balance is shared equally. So the first one, let's say that they had a net income of $98,800. So this is going to be similar to what we did the last part of 12.5 that we talked about. So again, net income, we see they had a total of $98,800, and then the salary allowance they have is Raymer has 50, Knox 40, and then they have the amount based on the investment, their interest. So 10% of 60,000 is 6,000, 10% of 90,000 is 9,000. So that means that Raymer then for the total salary and interest is 56,000, Knox is 49,000. So that brings us then to a total of 105,000. Well, guess what? That's more than the net income that they have. So we have a deficit there. So the total income or loss, well, right now we're at 62,000. So that's not going to work. So if you take that 62,000 and you divide that equally, which would be 3,100, that would then reduce the amount of the annual salary and interest. So then the income is distributed. So Raymer would be able to get 52,009. Knox would be able to get 45,009. So that allocates the income. Okay. It's because there is no remainder after you've done the salary, and you can't give them the entire interest allowance. Now, let's say that right off the bat that the business has a net loss of 16,800. So rather than having a net income up here, they already are starting out in the negative. So they had a net loss of 16,800. We would still be able to figure out then the amount of the salary and the amount of the interest. So that, but what happens then, so that means then that they have a loss then, balance of loss is 121,800 then, once you figure out how they're going to divide it up. So then that gets shared equally among the partners, so 60,900. And then the 16,800 loss is distributed. So then each of them would pay 4,900 for Raymer, and then Knox would pay 11,900. Let me show you how that works. So, for example, let's look at Raymer. So, if we have 56,000, and you subtract from that 60,900, that's how you're going to get the amount of the loss. So you just follow this same setup, and that's how you can then equally, fairly divide it up, and how they would share the loss if they use this kind of an agreement. Some more types of transactions, journalized and partnership transactions. So on March the 1st, Eckert and Kelly formed a partnership. Now, Eckert contributed $82,500 in cash. Kelly contributed land that was valued at $60,000, and a building that was valued at $100,000. The partnership also took Kelly's $92,500 long-term note payable associated with the land and the building. The partners agreed to share income as follows. Eckerd gets an annual salary allowance of $25,000. Both get an annual interest allowance of $10,000 on their capital investment, and the remaining income or loss is to be shared equally. On October the 20th, Eckerd withdrew $34,000 cash, and Kelly withdrew $20,000 cash. After adjusting and closing entries are made to the revenue and expense accounts on December the 31st, the income statement account has a credit balance of $90,000. And that $90,000 then would be the net income that the business generated during the course of the year. So we'll prepare the journal entries in order to record their initial capital investment. And so we have cash in the amount of $82,500, and that cash is the cash that Eckerd contributed. So then we would credit Eckerd capital $82,500, and then we have land in the amount of $60,000 debit, and that is the land that Kelly contributed, and we have the building in the amount of $100,000. But then we also have to then credit the amount of the long-term note payable that's on, more than likely it's in the form of a mortgage, and $92,500 is owed on that still for the land and the property. So then Kelly's investment then is $67,500. So then we see here that Eckerd has a capital balance credit of $82,500, and then for Eckerd, and then Kelly has a capital balance credit of $67,500. So now we're going to prepare the entry for the cash withdrawals. So we see that Eckerd withdrawal was $34,000, Kelly withdrew $20,000, and so then we would just debits withdrawals, and then cash of $54,000. And so again, that would go over here, and that would then reduce the amount of capital that each of them had. Now, we're going to prepare the journal entry in order to record a December 31st closing of both the withdrawals and the income statement. So we have Eckerd capital debit the amount of $34,000. Okay, and then Eckerd capital $34,000 debit, Eckerd withdrawals $34,000, and then Kelly capital $20,000, and then debit, Kelly withdrawals $20,000 credit, because that then adjusts how much is in their capital account. So then what we have to do then is we have to figure out the amount of income and how we would split that net income of $90,000. So we have total net income of $90,000. We said that Eckerd was going to get a salary of $25,000. Kelly, she doesn't. And then the interest allowance based on their initial investment. So 10% of $82,500 is $8,250, and then 10% of $67,500 is $6,750. And then the total salary and interest allowance for Eckerd is $33,250. Total for Kelly is $6,750. That brings us to $40,000. So then we have $50,000 then that we can divide equally amongst the partners. So they each get $25,000. And so then Eckerd will receive $58,250. Kelly would receive $31,750. And then that then allocates our net income. So those amounts then would be added to their capital balance. Then what we have to do is we have to go ahead and add that to their capital balance. So then we would debit the income summary, 90,000. Remember, income summary has a credit balance of 90,000 because that's to reflect the net income when we do our closing entries. Well, now it's December 31st. We want to close that out, prepare the books then to start for January 1 for the new accounting period. So we will debit the income summary account, 90,000. That closes out our garbage bag account, the income summary account, makes that 0. So then we would have Eckerd Capital credit the amount of 58,250, and then Kelly Capital credit the amount of 31,750. And then we can figure out then how much should be in the capital account balance for each partner. We said that Eckerd then has a capital balance the amount of 106,750, and then Kelly has a account balance now of 79,250. Calculate the balances again just to kind of check our work. Is we see the initial investment Eckerd had was 82,500. Eckerd withdrew 34,000, and then the share of the income was 58,250. So then the ending balance that would be in Eckerd is 106,750. And then Kelly, same thing. Her initial investment was 67,500. Withdrawal of 20. So then the share of the income is 31,750. The ending balance for Kelly is 79,250. And we see here that this, what we figure here, matches what's in our books. So we know then that everything was done correctly. How do we go about recording the entries for a sale of partnership interest? Biz Partnership allows partner Mandy to sell her $100,000 equity in the business to Brittany. Brittany pays Mandy $85,000. And so we'll record the partnership journal entry for the sale of Mandy's interest to Brittany in the amount. So on September the 30th. So we would go ahead and debit Mandy Capital 100,000, and then we would credit Brittany Capital 100,000. That's all we would have to do, because we're just changing in our books then that whatever the equity that Mandy has, we want to close out Mandy's capital account, and then we want to, and that's by debiting Mandy, we close out her capital account. Crediting Brittany establishes a capital account for Brittany. Now, we're not concerned with, let me show you. So we're not concerned with this portion right here. So it says here, Brittany pays Mandy 85,000. We're not concerned at all with that. That's something on the side, but that's not something that doing the books for the business that the business is concerned about. Okay, is what happened there. Okay, is the admission of a new partner. The Struder partnership has total partners equity of 510,000, which is made up of Main Capital, the amount of 400,000, and Frist Capital, the amount of 110,000. The partners share net income and loss at a ratio of 80% for Main and 20% for Frist. So on November 1st, Addison is admitted to the partnership and given 15% interest in equity and a 15% interest in share of any income and loss. And so we'll assume that Addison invests $90,000 in cash. So the first thing that we'll do is we'll prepare the journal entry for the admittance of Allison. And so we see here the equities of the existing partners, the 400,000 and the 110,000 is 510,000 total. And then Addison's investment of 90,000. So the new partner's equity then would be $600,000. And so the ownership percentage we said was 15%. And then Addison's equity is 600,000 multiplied by 15% is 90,000. And then we see here that Addison's investment is 90,000. Her equity is 90,000. And so there's no bonus that would be distributed because what she's putting in as an investment equals her equity. So we receive cash in the amount of 90,000 debit, and then we would go ahead and just simply credit Addison's capital for the amount of 90,000. That just establishes her capital account. Now the next one here is a little bit different. This is, we're going to say then that, let's look at another example. First one was really easy, but this one, we're going to say that Addison invests a total of 120,000 into the business, and so we'll prepare the journal entry for the admission of Allison. So we see that the equities of the existing partners of Main and Frist is a total of 510,000. Addison's investments 120. So the total new partner equity would be 630,000. But again, if Allison's percentage ownership is going to be 15%, because we see that she's given a 15% interest in the equity, so that would be what her ownership is. And so 15% of 630,000 is 94,500. And so again, her investment is 120,000, and then her equity is 94,500. So the bonus, she has to pay a bonus to the old owners in order to be admitted. And so she has to pay a total of 25,500, which consists of, to Main, 80% of the net income or loss would be 20,000, 20% for Frist would be 5,100 again. So that's how we allocate how much the bonus would be. So we receive cash, the amount of 120,000 debit. We would credit Addison Capital at 94,500 because that's the amount of equity that she has in the business. And then we would credit Main Capital the amount of 20,400 because that is Main's share of the net income or loss. In this case, the net income bonus over the amount that she, of the equity over the amount of Addison's investment. So 20,400 credit, Frist Capital, same thing, credit 5,100. Let's say that Addison invests cash of 80,000. So we see that again, the equities of the existing partners is $510,000 total. Addison's investment is 80,000, and so the new partnership equity is 590,000 for all three of them. Her percentage remains at 15%. And so we see that 590,000 multiplied by 15% ownership. So the total equity multiplied by the 15% that would be Addison is 88,500. And so again, we see that Addison's investment is 80,000. Her equity would be 88,500. So they would have to pay her a bonus in the amount of $8,500. Of that, Main would be responsible for paying $6,800 of it because 8,500 multiplied by 80% is 6,800. Frist would be responsible for paying 1,700. Again, 8,500 multiplied by 20%. So we see here that we have cash debit, the amount of 80,000, that would be the investment from Addison. Then we have Main Capital debit, the amount of 6,800 because we're reducing the amount of capital that Main has. And then we have Frist Capital debit, the amount of 1,700. And then Addison Capital, then what would be in her account would be 88,500. And then we see here too that our debits still equal our credits. Now we're going to discuss what happens upon the retirement of a partner. So we've talked about what happens when we admit a new partner into our organization. So if we into our partnership, now we're going to talk about what happens when that partner decides that they want to retire. So Hunter, Folgers, and Tulip have been partners while sharing net income and loss on a 5-3-2 ratio. So that would be Hunter would be 50%, Folgers 30%, and Tulip 20%. So on January the 31st, that would be the date that Tulip retires from the partnership. The equities of the partners are Hunter 50,000, Folgers 90, and Tulip 60. So we will prepare the journal entries to record Tulip's retirement based under each separate assumption. So first of all, we're going to assume that Tulip is paid $60,000 for her equity using partnership cash. So we would go ahead and debit Tulip Capital the amount of $60,000 because that will close out Tulip's capital account. She has a credit balance right now of 60. Upon doing this, we debit, so it would go ahead and zero out her capital account, and then we would credit cash 60,000 because the partnership is paying out cash. Now we can assume that Tulip was paid $80,000 for her equity using partnership cash. So she's paid more in order for her to retire. So the first example is she's paid out the entirety of her capital, no more, no less. This time she's going to, number two, she's going to be paid more than what her equity was. So we would debit Tulip Capital the amount of 60,000 because that closes out the capital account. We can go ahead and credit cash 80 because we know that that's how much she'll be receiving. So Hunter Capital, we would have to debit that 12,500, and so that would be 5/8 multiplied by the $20,000 difference. And the reason for that is we wouldn't worry about her. You're going to have the remaining partners, so 5/8 of the amount. That would figure out then how much bonus she would be paid, so it'd be 12,500. Then Folgers Capital would be 3/8 of 20,000 is 7,500, and that's how you would allocate that. So it would reduce the partner's capital balance in order to be able to pay her out. And then we could assume that Tulip is paid $30,000 for her equity. So that means that Tulip has to give up some of her equity in order to get out of the partnership. So she owes that to the other partners. And so we would debit Tulip Capital 60,000 again. That's how much she has in the capital account. That closes out the capital account for Tulip. And then cash the amount of 30,000 credit because that's the cash that Tulip would be receiving. And then we would have to go ahead and credit Hunter. Again, 5/8 multiplied by 30,000 is 18,750 for Hunter. And then for Folgers would be for 3/8. So 3/8 multiplied by 30,000 is going to be a credit of 11,250 because we're now going to add to the capital balance of the remaining partners. Is we're going to discuss what happens when we liquidate a partnership, meaning that the partnership is dissolved. It's no more. We're ending the partnership. It's going out of business. So Turner, Roth, and Lowe are partners who share income and loss on a 1-4-5 ratio. So again, Turner would be 10%, Roth 40, Lowe 50. Now the partners decide to liquidate the partnership. So they're going to close their business. And so immediately before liquidation, the partnership balance sheet shows the following total assets of 126,000, total liabilities of 78,000. Turner had capital of 2,500, Roth had capital of 14,000, and Lowe had capital of 31,005. Cash received from selling the assets was sufficient in order to repay all but 28,000 of the creditors. So they still owe the creditors money, and so we have to take that into account as well. So first of all, we will calculate the loss from selling the assets. So the book value of the assets that were sold was $126,000. And then the liabilities before liquidation was $78,000. So that's what they had. So they had assets of $126,000, liabilities of $78,000. And so after they paid their liabilities, but they still owed $28,000. So that means that the payment of liabilities using cash from sales of assets was $50,000. So that's how much they could pay. So they had a loss on sale of assets of $76,000. So we have to allocate the loss to partners. So the ratio again by percentage and then the amount. So we see that the initial capital balances again are listed, total capital of 48,000. Then the allocation of the loss. So 1/10 of it, or 10% for Turner, is $7,600. 40% of it is $30,400 for Roth, and then for Lowe, half of it, 50%, is $38,000. So that equals out to 76,000. And so then the capital balance, what that would be. So we subtract the 76,000 from, subtract 25 from it. So the capital balance then would be a negative 5,100, negative 16,400, and negative 6,500. So then that leaves negative 28,000 total of what partners owe. They will determine the amount of liabilities to be paid by each partner. So the amount to be repaid then would be 5,100 for Roth, for Turner, Roth 16,400, and then Lowe 6,500. So that's the amount that remaining that they would each need to pay in order to clear up all of the liabilities of the business. The liquidation of limited partnership. Because in the first example we looked at just now, they each are responsible for this. But we see here that some of the partners have what would be considered a limited partnership. So we'll calculate the loss from selling the assets. Again, $76,000 loss. So we'll have to allocate the loss to the partners the same way. So the initial capital balances are listed, and in the allocation of the loss. So again, 1/10 of 76,000 is 7,600 for Turner is responsible for. Roth would be 40%, which is 30,400, and then Lowe would be 50%, would be 38,000. And so the capital balances before would be negative 5,100 for Turner, negative 16,400 for Roth, and negative 6,500 for Lowe, because they were able to use some of their capital in order to take care of it. Now we can assume that Turner, Roth, and Lowe partnership is a limited partnership. So we'll say that Turner and Roth are considered general partners, and Lowe is considered a limited partner. So then how much of the remaining 28,000 would be paid then by each partner? So we have to then also allocate the portion then that Lowe had. So because Lowe would not be responsible for the loss. That's why he's a limited partner, is because he doesn't want to be responsible for the loss. And so then we would figure out then that 1/5 of the loss, because that's the remaining partner, and then 4/5 would be for Roth. And so 1/5 of the 6,500 is 1,300, and then 4/5 of 6,500 is 5,200. So then that brings the capital balances after the allocation of the deficit, then that Turner would have a negative $6,400. Roth would have a negative $21,600. So each Turner and Roth, that's what they owe back to the partnership in order to settle the remaining of the liabilities. And so the amount to be repaid by the partnership then to the partnership would be $6,400 for Turner and $21,600 for Roth. Lowe would not owe anything additional back to the partnership because Lowe is considered a limited partner, and Turner and Roth are considered general partners in the partnership. Rugged Sports Enterprises LP is organized as a limited partnership consisting of two individual partners, hockey LP and football LP. So we're going to compute the partner return on equity for each limited partnership, and then of course on the total for the year using the selected data. So in order to calculate the return on equity, you take the net income divided by the average equity. So in this case, we can just look up here and we see that the annual net income for hockey LP is $22,208. Now to calculate the average equity, we're going to take the beginning equity for hockey LP, which is $189,000, and add the ending equity, which is $211,208. That gets you $400,208. Divide that by 2, gives you $200,104. So if we take that that gives us 11.1 for the rate of return on equity. So we could do the same thing then for football LP. So we have that the annual equity is $445,473, and then we take the average, which is $955,737, and so we take that, we divide. We get that, and it comes into 46.6%. And then we can go ahead and do the same thing then for the, and I'll show you how they do that for the total. So just move that there. So we take the beginning equity, which is 947,000, add the year-end equity, and then divide that by 2, gives you, hold up, try that again. Is 1,155,841 would be, because 0.5, so you could round up. And then we take is 40.5% return on equity.